We're back on Morning Movers. All eyes on Apple this afternoon. It's all dropping. Product launch set for 1 p.m. Eastern time today. The company expects to unveil an iPhone 17 Pro, iPhone 17 Max model, as well as a new ultra-thin iPhone Air. The tech giant also expects to announce updates to its watch, AirPads, and iPad Pro. Time now for Options Corner. Joining us to take a deeper look at Apple is Rick Ducat, lead market technician here on Schwab Network. All right, Rick, what do you notice about this chart?
Apple could use a little shock and awe at this point to shake things up for share prices. Here you can see underperforming not only its own tech sector here, but the broader market. And, you know, you mentioned a lot of products, Diane. It didn't seem like there's too many things focusing on AI. That's the thing everyone seems to be talking about with all of these tech companies lately. Microsoft, Meta, Google, these are Apple's main competitors in this AI race, in which Apple seems like it's been a laggard here. So really underperforming notably these other big tech names here. But to look at Apple's chart more specifically, we can see now that we have crossed above these old highs here near 235, our green dashed line there. So we had this consolidated phase. Now we have broken above it and so far held on to those lows near 235. So if those were to be retested once again, the yellow 21-day exponential moving average comes in right around 230 or so. We can also see the 220 level, our light green line, a frequent low point for price as we progressed through our trading activity here. That was also the breakout point here once again, and about where we formed a notable gap back here as well. RSI compressing in a triangular pattern, momentum starting to wane somewhat here as we cross back below that overbought area here, typically regarded as a sign of strength in a trending market. If we were to look a little bit closer here, we can see that same 230 level lines up with our volume profile point of control, our heavy trading area here. If you were to look a little bit to the upside, 247, that's about where we have this another additional high point here, a double top type high, as well as where the volume starts to really drop off here as well. So now we have a bit of a range to consider here. We have this lower boundary near about 230 or so. We have an upper boundary near about 247. We also have our +2 standard deviation channel here as well. So this could provide a further weight to this upside target area potentially. Now, if we were to also consider our expected move for the September monthly option here, 10 days to expiration, we've got a range of about 3.5% here. Now, if you look at the numbers though, 245 on the upside, 228.50 on the downside, that lines up pretty closely with that expected range that we were talking about here. So those could be areas to consider potential strike prices or stop loss areas here. Really, it's up to the trader to decide how they want to play this name as we head into this awe-dropping event here so far. I really wonder what the focus will be in terms of the AI news that we'll see.
A new iPhone. I don't have a new one. I didn't get a sneak peek or a new release right now. All right, now to take us through an example trade is Tom White, senior options contributor. All right, Tom. So, shock and awe. What's the example trade approach you got for this one?
Yeah, awe dropping. It almost reminds me of that word super cycle that everybody's used for the past few years that's actually never taken place. So keep that into context. Going into these product launches, typically we see a pullback in the stock. Remember, Apple had the best month that it's had in the month of August in about a year, and rose another 3% last week. So it's rebounded sharply from those April lows going into this. So hype is there. That's one of the key things. Implied volatility levels on this rally back are really low. IV percentile rank about 13%. So I looked at a strategy. If you want to fade maybe this move that we've seen, maybe we're going to see some disappointment, but give yourself some time in this trade. It's not a short-term positioning based on this product launch. I went out to the October monthly option, so 38 days to expiration, where I'm going to buy a put vertical. Because we've got implied volatility levels really low at this point, these verticals are going to cost me less money and I'll have less risk on these trades. So going out 38 days, we're going to buy the in-the-money 240 strike put. Stock looks like it's going to open up about $237.50 here. So it's about $2.50 in the money. We're going to buy the 240 put. Then against it, to offset some of the costs on this bearish put purchase, we're going to sell the 225 strike put. So a bearish $15 wide put vertical to the downside. You're going to pay roughly about a $5 debit if the stock opens up here. That's going to be your risk. $500 per spread, where you can make an extra $1,000, right? If this thing goes below 225 over the next basically 6 weeks or so. If you pay that $5 debit, takes your break even down to 235. That's about 1% below where the stock is going to open up today. So you don't need that monster move to the downside. Now, if you want to do something short term where you think this, awe-dropping event's not going to, come up to expectations, you can do something shorter term. It might cost you a little bit more, but because of that low implied volatility, you're buying a put vertical that's directionally bearish, right? Well, that gives you that flexibility over the next 38 days. You don't need the move right after the event. Maybe the stock goes higher, but you've still got 38 days in this position to offset some of your risks, maybe close a portion of the position. So it gives you a lot of flexibility as far as trade management goes on a directional bias trade. Now, if you're more bullish on a name like this, implied volatility levels are low, right? You can buy a call vertical if you think the stock's going to rise after this event, or maybe over the next 38 days if you use the October option. So there's a lot of flexibility as far as trade management goes, but then you start looking at different option series based on what assumption you have on the stock over a specific period of time post that. But this is a bearish outlook. I'm not saying I'm bearish, but this is just an example. If you think this stock's going to start to pull back from the recent rally that we've seen.
I like the caveat that you put on that. But I will, even though I know a lot of jokes are made about, the new iPhone, I am looking to see what it will be like. And I know, it was supposed to be a super cycle last year. And so we're being a little bit tongue-in-cheek here. We'll see. Maybe this will be the catalyst that Apple needs. We'll see. Yeah. But that example trade there is a put vertical. So, there we have it. Thank you, Tom.